Owning shares simply means that you're a part owner of a business. So if you buy shares in a technology company or an infrastructure company, you simply own a small piece of that company. There are a range of different companies listed on the share markets across the world. Here in New Zealand, for example, we have about 150 different companies that are listed on the NZX. Around the world, there are tens of thousands more, and you can get exposure to just about any sort of industry or sector that you like, from technology to property to construction to healthcare or anything in between. As a shareholder or investor in a company, you're going to share in the ups and downs of that company. Hopefully your company will grow, its profits will go up, and its share price will go up too. In that scenario, your investment will be worth more than it previously was. However, your company could run into troubles or problems. Your investment could be worth less, and the opposite could happen. Now, many companies pay dividends. Dividends are the share of the profits that the company makes that they choose to distribute to their investors. So if you own a company that's paying dividends, you might get a distribution every 3 months or 6 months or similar, which will be your small share of the profits that that company has made. As a shareholder, you'll get regular communications from the companies that you own shares in. These could be progress reports or other sorts of updates that tell you how the business is going, the challenges it's facing, and the opportunities ahead of it. Most companies will hold an annual meeting every year. Now, this will give you a further opportunity to hear the board and management talk about how the company is going and what they're doing, how they're achieving growth, and it will give you a chance to ask questions. There are a number of ways you can invest in shares. You can do your own analysis and background work and use a discount online broker to do your buying and selling. You can go to a full service broker where you might get research, advice, tax reports, and a much wider suite of material. Or you can use a managed fund, which is a pooled investment vehicle where you're effectively outsourcing the decision making to a fund manager who will make those decisions on your behalf. And this is similar to the way KiwiSaver funds are usually set up. Now, each of these three methods of owning shares are different, and what's right for one person might not be what's right for the next, so it really does come down to your own personal circumstances and your individual objectives. In terms of the way you get your money out of the share market, one of the advantages of investing in shares is that they are very liquid. Now, being liquid means that they're traded very frequently, almost daily, and you can buy or sell small or large amounts very quickly and very easily. The price of shares is market driven, and the market is made up of a lot of buyers and sellers. Now, the price that they're going to be willing to trade shares at will change on a daily basis. It'll be driven by factors like economic sentiment and the prospects of those individual companies. That's why it always makes sense to invest in shares with a long-term view. If you'd like to know more about investing in the share market, please visit the following websites.